You can own a rental property this 2024 even if your pockets feel empty right now. Yes, it's possible, and I'll show you how. Before we jump in, hit that subscribe button and ring the bell to stay updated on transformative real estate strategies. What's up, everyone? My name is Tommy, and I'm a top producing real estate agent in Chicago and the co-founder of Weinberg Troy Residential. We've sold over 2,000 properties and generated over $1 billion in closed sales volume. And let me tell you about this major misconception home buyers have, thinking that you need a lot of money to start investing in real estate today. If you're looking at your bank account and asking how it's even possible, guess what? There's ways around this. Allow me to reveal the secrets to breaking into real estate investment, even if you're starting with little to no financial backing. When diving into real estate investments, it's essential to understand the difference between cash flow markets and appreciation markets. These terms describe different investment strategies and economic behaviors in different geographical areas. So your investment choice should align with your financial goals, risk tolerance, and investment timelines. So let's break down the distinction and discuss which might suit your situation best. Let's start with cash flow markets. Cash flow markets are typically found in regions where the purchase prices of properties are relatively lower, but rent demand remains steady. These areas, they might not experience rapid economic growth or sharp property value increases, but they can provide a reliable monthly income. Some common features include higher rental yield percentages, lower entry costs, and stable long-term tenants. Let's break down what this looks like financially. So suppose you buy a property for $100,000 in, let's say, a suburb of Chicago. You're able to rent it out for about $1,000 a month in rent. And after accounting for your expenses like property taxes, insurance, and your maintenance costs, which we can roughly estimate about 40% of the rental income, your net monthly cash flow would be $600. This leads to an annual cash flow of $7,200, which is a 7.2% cash-on-cash return, which doesn't include any potential mortgage payments. So what are appreciation markets? Appreciation markets are generally located in rapidly growing economic areas. These can be metropolitan areas or cities experiencing significant population growth or high levels of tech investment or even infrastructure developments. The features of these markets include lower rental yield percentages. When you compare them to the property value, you're going to see higher purchase prices and potential for significant property value increases. So let's break that down financially. What could that look like? Well, consider a property in a thriving urban area like Chicago, where you purchase a home for $1 million. The rent you can charge might be $3,000 per month. After the same expense ratios we used before, about 40%, your net income from rents is $1,800 per month or $21,600 annually. Here, the cash-on-cash return is only 2.16%. However, the property appreciates at 5% per year, which is pretty conservative. The gain in value would be $50,000 annually. So how do you choose what's best for you? Well, you gotta weigh out the risk versus the return. See, in cash flow markets, those are the best for seeking out stable, predictable income without the necessity for immediate or rapid property value increases. These are obviously ideal for retirees or those that are nearing retirement age. And in appreciation markets, well, those are suitable for investors who are a little bit more risk tolerant, looking for potential high returns through property value increases. This is often more speculative and can be more sensitive to market downturns. Short-term investors might find appreciation markets attractive if they're betting on quick shifts in property values, while long-term investors might prefer cash flow markets for ongoing income, especially if they're leveraging the property as part of a broader retirement strategy. I'll give you a real-life example of clients of mine for both, right? First, a client of mine invested in a cash flow market, purchasing several units in a stable area that had high demand for rentals. This gave them a steady income that supported other less liquid investments that they had. Now, another client of mine, she opted out for an appreciation market, buying in an up-and-coming area called Logan Square, and she faced initial cash flow challenges, but eventually sold the property for a substantial profit of $500,000 as the neighborhood grew in popularity just in 12 years. Understanding your financial goals and the nuances of each market will guide you to make the most informed decision. Now, whether you aim for steady income or gearing up for a big future payoff, knowing these differences is crucial in crafting a strategy that aligns with your financial landscape. Once you've chosen a property, the next step is to determine how you can maximize its potential. A key decision here is whether to opt for short-term or long-term rentals. And each strategy has its pros and cons, and the choice can significantly impact your revenue stream and investment workload. Moreover, whether you're a W-2 worker or an entrepreneur, your approach to property management can differ based on your income stability, time availability, and your business acumen. Now let's go over the pros and cons for both short-term and long-term rentals. First, short-term rentals. Well, the pros, higher potential income per day. You have the flexibility in pricing and availability, and you can adjust these for peak seasons as they come and go. Also, you have the opportunity to use the property for your personal purposes during any vacancy. The cons, well, it's a more intensive management and higher operational costs with more monthly turnovers. Income can be highly variable based on seasonality and market demand. And the last part, which stinks, regulatory challenges or restrictions in certain cities may block you from doing short-term rentals. Now let's get into the long-term rentals. Well, the pros, you have more consistent and predictable income. You have a lower maintenance and management effort after the tenant moves in, and longer tenant contracts can reduce vacancy rates significantly. The cons, well, typically lower rental years compared to short-term daily rentals, and less flexibility to use the property or even adjust rent prices frequently with seasons. Also, the potential for long-term wear and tear from tenants can be a negative side of long-term rentals. Now, when it comes to maximizing returns, there's different strategies for different financial situations. Let's first start with the W-2 workers, right? Suppose you have a stable job and a reliable income, but limited time due to your 9-to-5 work commitments. While opting for a long-term rental strategy might be more suitable as it's less demanding with less daily involvement. And once you utilize property management services, that can further reduce the burden, allowing you to enjoy your passive income. The strategy for those W-2 workers is to automate and delegate. You want to invest in systems like property management software and invest in services like an actual property management company that can handle day-to-day operations for you. Take that off your plate. This way you can focus on your 9-to-5 while your investment works for you. Now, if you're an entrepreneur with fluctuating income but more flexible time, engaging in a short-term rental strategy can maximize income potential, especially if you can actively manage the property and adapt to the market changes. The strategy for the entrepreneur is personal involvement and dynamic management. You see, entrepreneurs can leverage their flexible schedules to improve guest experiences and optimize pricing dynamically with market trends, and also possibly even expand into multiple properties more rapidly. Now let's talk about another strategy called the 3M framework. This is a strategic approach that's designed to help investors and business owners effectively grow and manage their assets. You see, this model is structured around 3 core principles: make money, manage business, and multiply wealth. Each component focuses on a different aspect of financial and business growth, providing a clear path from starting an investment to expanding it into a substantial asset portfolio. Here's a breakdown of each stage. The first stage is all about generating initial capital and establishing a solid income stream. For a real estate investor, this means identifying and acquiring properties that offer good returns on investment. The key activities in this phase include market analysis, which is researching the best markets for investment, whether for cash flow or appreciation potential, financial assessment, evaluating the costs, potential income, and profitability of the properties, then acquisition, actual purchase of the properties that meet your strategic criteria. The goal here is to build a stable foundation of assets that generate reliable income. Then you go to manage business. Once you have properties or other investment generating revenue, the next step is efficient management. This phase focuses on optimizing operations to maximize profits and reduce hassles. It includes implementing systems and processes to streamline management tasks such as rent collection, maintenance requests, and tenant communications. Then there's cost management. You want to minimize expenses through efficient property management, negotiating better service rates, and keeping lower overhead. Then there's quality control, maintaining high standards for property conditions and tenant relations to ensure continued profitability and prevent costly turnovers. Effective management is crucial for sustaining long-term income and providing the erosion of your initial gains. The third M is multiply wealth. The final stage of the 3M framework is all about leveraging the success and stability of your existing investments to further increase your wealth. This can involve reinvestment, using profits from your investments to fund additional properties or other types of investments. Also, diversification, expanding into different markets or types of investments to spread risk and increase potential returns. And finally, good old leverage, utilizing financial options like mortgages or other loans to expand your investment portfolio without tying up all your liquid capital. This stage is focused on growth and expansion, aiming to turn modest initial gains into significant wealth. In practical terms, applying the 3M framework involves careful planning and strategic execution at each phase. For example, a real estate investor might start purchasing a few residential properties, optimize their management by hiring a property management company and using some sort of prop tech software tool, and then use the equity from those properties to invest in large commercial properties or diversify into stocks and bonds. This framework provides a structured approach to building and expanding a successful investment portfolio, aiming to achieve both short-term profitability and long-term wealth creation. At the end of the day, choosing between short-term and long-term rentals depends on your personal situation, financial goals, and capacity for involvement. W-2 workers might prefer the stability and lower involvement of long-term rentals, while entrepreneurs, they might capitalize on the higher income potential and flexibility of short-term rentals. Applying the 3M framework we talked about can help both types of investors grow their initial investment into a robust portfolio, ensuring a solid financial future and achieving substantial financial growth. Which investment strategy resonates most with you? Chasing cash flow or banking on appreciation? Let's discuss in the comments below. When it comes to investing, especially in real estate, jumping in without a solid foundation of skills is like trying to run a marathon without any training. You might make it a few miles, but you're not going to enjoy the journey, and you definitely won't like the results. That's why the skill development is absolutely critical before laying down any cash on any investment. Let's break down why honing your skills is as important as capital you're looking to invest. First, you got to understand the market. One of the most critical skills in investment is understanding the market dynamics. This includes recognizing trends, identifying growth areas, and knowing the cyclical nature of real estate. With solid market knowledge, you can predict potential downturns or upswings, aligning your investment strategy to be both defensive and aggressive when it counts. Next, you need to have financial acumen. You see, investment is a numbers game, and having a strong grasp of financial principles is essential. This includes understanding financial options, mortgage rates, investment property taxes, cash flow analysis, and the overall economics of a property. Skilled investors are adept at crunching numbers to ensure that every investment has a solid return potential with minimized risks. Next, you need to have great negotiation skills. You see, real estate investment involves a significant amount of negotiation, not just on purchase prices, but also in securing favorable loan terms, dealing with contractors, and managing tenant relationships. Effective negotiation can lower your entry costs, increase your profit margins, and help maintain a positive cash flow. You also have to know the laws. Understanding the legal and regulatory environment is crucial in real estate. This means knowing zoning laws, understanding tenant and landlord laws, and being aware of future regulatory changes that can impact your investment. Compliance not only avoids legal troubles, but can also offer opportunities for strategic advantages in crowded markets. Last, and probably the most important in my opinion, is networking. You see, real estate isn't just about properties, it's about people. Building a network of contacts from agents and fellow investors to legal advisors and mentors, that can provide you with inside advice and opportunities that are not available through market data alone. By developing these skills before investing, you're essentially building up a toolkit that'll help you navigate the complexities of real estate investment with greater confidence and precision. The time and effort you invest in skill development can exponentially increase your success rate. Remember, in real estate, you're not just investing your money, you're investing your time and your knowledge. The sharper they are, the better your returns will be. Identifying the right location for your real estate investment is like setting up a chessboard. Position is everything. Here's some practical tips to help you scout out the best investment locations using tools like maps, demographic data, and market analysis. Let's dive into how you can leverage these resources to make informed decisions. The first resource is Geographic Information Systems maps. These are invaluable for real estate investors because they provide detailed geographic and demographic insights. These maps can show you property boundaries, zoning laws, flood zones, and other critical geographical data that may affect your investment. By using GIS maps, you can visually assess the potential of different areas and avoid locations with geographical drawbacks. The next resource is to analyze demographic and economic data. You see, understanding the demographic and economic trends of a potential investment area is crucial. What you want to look for is population growth, right? Areas with rising populations are typically promising for any real estate investment. Next, look at income levels. Higher average income can signal a stronger rental or buyer market. Employment rates are also important data and statistic to look at because strong local job markets attract more residents and reduce tenant turnover. Age distribution is also another key data point. Knowing whether an area is popular with retirees, families, or young professionals can influence a type of property you should consider. Websites like the U.S. Census Bureau provide free access to a wealth of demographic information. Also, local government websites often have economic development sections that highlight growth and investment in the area. Next, focus on infrastructure and development projects. You see, real estate values often increase in areas with growing infrastructure. So keep an eye out for public transportation, right? New or expanding public transport options can definitely increase property demand. Schools and hospitals. Investments in educational and healthcare facilities can make a neighborhood more attractive. Also look for commercial developments. The introduction of shopping centers, office buildings, and entertainment venues can boost local real estate values. Check out city or county development plans often available online or at the local planning offices. You also want to evaluate market trends and comparables. Work with a real estate agent to analyze market trends and property values. Look at historical price trends. How have property prices changed over the years? Make sure you're checking current listings and recent sales. What's the average time on the market? What are properties selling for compared to their list price? Next, get out in the streets. Conduct your own field research. Nothing beats seeing the location for yourself in person. Visit the area at different times and days to get a feel for the neighborhood. Talk to locals. Speak with the shop owners, residents, local real estate agents to get an insider's view on the area. Take a look and observe the environment too. Look for signs of upkeep in both public spaces and private properties, and check for signs of economic health. Are businesses thriving? Are new companies moving in? Are there a lot of vacant retail commercial spaces? And finally, leverage your social media and local forums. Many people overlook this, and I think it's one of the greatest resources, and it's free. Platforms like Nextdoor or local community Facebook groups, they can provide insight into what locals think about an area. These platforms can be gold mines for understanding community issues, local developments, and just the overall vibe of the neighborhood. By combining these techniques, leveraging technology for data analysis, keeping an ear to the ground through local engagement, and staying updated on infrastructure developments, you can significantly increase your chances of identifying profitable investment locations. Remember, the more thorough your research, the better position you'll be to make a strategic investment. Diving into real estate investment without a hefty bankroll might seem like a challenge, but it's totally doable with the right strategies. Understanding your loan options and creative financing techniques is key. Let's break down some viable paths for those with limited funds to get into the investment game. First, FHA loans. FHA offers loans that are perfect for first-time homebuyers or those who have haven't owned a property in a while. These loans are appealing because they require a lower down payment, typically just 3.5% down. Plus, the credit requirements are less stringent than conventional loans. So this can be a game changer for those with less cash on hand or less than perfect credit score. For our veterans and active military, VA loans are a fantastic resource. See, these loans require no down payment and they don't necessitate private mortgage insurance, also known as PMI. VA loans are backed by the Department of Veteran Affairs, which makes lenders more comfortable with offering favorable terms. This can dramatically reduce the initial capital needed to start investing in real estate. Another option can be through seller financing. This is where a seller of a property acts as the lender. Instead of paying a bank, you make payments directly to the seller under agreed upon terms. This can often bypass the need for traditional loan qualifications and down payments can be negotiable. So seller financing can be particularly attractive if the seller is motivated to sell quickly or the property has been on the market for a while. Another option many people overlook is the lease option, right? Lease options allow you to rent a property with the option to buy it later. This can be a great way to get into a property with less upfront cash. Part of your rent payment typically goes towards the purchase price, which can also help build equity before you even officially own the property. Another option are through hard money loans. These are short-term loans offered by private investors or companies, not banks. Hard money loans can be advantageous for properties that need quick closing or for those that aren't in a condition for traditional financing. The trade-off is usually higher interest rates and shorter repayment terms. Another option is leveraging through partnerships. Teaming up with another investor or a group of investors can reduce the amount of capital each person needs to contribute. In a partnership, you can pool resources for down payments and share the management responsibilities. Partnerships can also allow you to leverage the skills and networks of others, potentially opening up more investment opportunities. Also, look into government grants and programs. Depending on your location, there may be government programs available to help you get into real estate investing. These can include grants for buying properties in certain areas, funds for renovating distressed or historic properties, or incentives for investing in rental housing. Starting your real estate investment journey with limited funds might require a bit more creativity and strategy, but it's definitely possible. Exploring these financing options can open many doors, even when your initial capital is low. Always remember to carefully assess the terms and potential risks associated with creative financing options. As always, consultation with a financial advisor or especially a real estate professional is highly recommended and advised to tailor these strategies to your specific situation. In the world of real estate investing, networking isn't just a buzzword. It's one of your most valuable tools. It's about building relationships that can lead to partnerships, mentorships, and opportunities that might never be found through traditional channels. Think of your networking as your on-the-ground research and development team that keeps you connected to the pulse of the market, new trends, and investment strategies. So let's break down some networking opportunities and strategies that you can take advantage of. Make sure to attend industry conferences and seminars. These are gold mines for contacts. You also want to make sure you're equipped with a well-crafted elevator pitch about your investment focus and goals for who you really want to meet. Look for real estate investment groups and associations in your area to join. Being part of these groups gives you a regular schedule of meetings and events, making it easier to make new contacts and stay informed about local market conditions. Also, one of the greatest resources is in the palm of your hands: social media. Platforms like LinkedIn are powerful tools for connecting with industry professionals. Share your insights, comment on other people's posts, and participate in discussions to raise your profile and influence. One of my favorite strategies is hosting your own events. This can be a webinar or a small local meetup that's in person, but by hosting, you position yourself as an authority figure and the go-to person in your niche, attracting others to you. Look for opportunities to volunteer for leadership roles in community organizations like your local chamber of commerce. This not only benefits your community, but also puts you in contact with other business leaders. Remember, networking in real estate isn't just about collecting business cards. It's about building relationships that grow with your career. Each event you attend, each person you meet, and every relationship you nurture is a step towards more profound newfound market insight and greater opportunities. So the next time you're at a networking event, remember, each handshake has a potential to turn into a profitable partnership. If you find these steps hard, don't worry. We'll help you through it. Just click the link below for a free consultation. Did you find this guide helpful? Like, subscribe, and click the bell for more insider tips. And let's make your real estate investment dreams into actuality.